lot of first-time home buyers do not understand what's the CMHC, the Sagen, or the Canada Guaranty, 3 companies, mortgage default insurance. Today I want to clear up what exactly the heck that is, how you manage it, and how there's different premiums based off your different tranches of down payment up until 20%. I'm also going to challenge if it's even worth doing under 20% or why it might definitely be worth it. That's another topic related to another video actually. And we're going to go over how do you mitigate this mortgage default insurance that you're paying is costing you money. Without further ado, let's jump in. First things first, a lot of first-time home buyers say, how do I get into the market with as little cash as possible so I can just get into home ownership? Not a bad thought. Now, a lot of people don't realize that, again, there's different tranches, and based off your tranches, you're paying more of this premium. So before you decide whether you're going to put in 5%, 15, 10%, or maybe 20, we're going to talk about exactly what the cost of that is and who these companies are. Okay, zooming out. There's many different insurances you have to pay when you buy a home. There's home insurance, there's critical life and disability insurance, there's mortgage default insurance, there's many. The first 2 are actually to protect yourself. What's really weird and honestly a bit unfair about mortgage default insurance, it's not an insurance for you. You get zero benefit buying it. It's actually a default insurance where if you default, the government guarantees your loan to the lender. Kind of weird, but why are we paying for an insurance that protects the lender? And who says we're going to default? That's like a pretty rare thing. Anyways, that's the catch to be able to put in less than 20% down payment, and you have to pay. So if you're against that, you don't think it's fair, and you have 20%, quick answer is when you do 20%, you're not paying for the insurance. That's handled by the lender and the government. So if you have 20%, might be worth it. Again, we'll get to that, but that's the general philosophy around it. 3 companies offer it, and these companies do pretty much the exact same thing. There's CMHC, which is the most famous one, Sagen, and Canada Guaranty. They all have the same premiums. The only differences between the different companies is some of them have a bit more of a acceptable or favorable program for people that are self-employed. For example, Sagen is especially good at that. Some of them flag properties differently than other ones. And just take a step back, actually, you might have a lender accept your loan, but when it's under 20%, if they want that default insurance to be valid, these 3 insurance providers, they have to actually accept. So actually, when there's under 20% down payment, a lot of people get turned down because the insurance provider, again, CMHC, Sagen, and Canada Guaranty, they're super strict because they're guaranteeing that. This is why a lot of people under 20% are pretty handcuffed in flexibility, very low flexibility. So just by the way, it's very important. So again, they're all very similar. They've got slight nuances, and they're all super picky on your debt to income ratios and other exceptions. So by the way, if you're trying to get an exception under 20%, good luck. Okay, so I know that there's these 3 companies. By the way, you don't choose them. The lender does based off who they have a relationship with. And by the way, who the lender thinks will be more likely to accept your file. So the lender's on your side most of the time. So that's a bit about the default insurance, the providers, the nuances around which one it goes to. But regardless, without further ado, let's get into the numbers of this. Okay, so you can generally put down minimum 5% down payment as long as the property is $500,000 or less. You do not have to be a first-time buyer for this. It can be anyone, just by the way. So when you put down 5%, let's say on a $500,000 property, that's $25K. The mortgage is $475,000, okay? Take the $475, and generally when you put in between 5% and 9.99, there is a default premium. And typically that premium is around 4%, okay? So I have a chart actually right over here, and you'll see 3 examples. It's the same property price, but there's different tranches, 5%, 10%, 15%. You'll see in one of the rows there that the premium jumps up, as low as 2.8 all the way up to 4-ish, okay? And these are generally set, but always double check with your broker. These premiums can sometimes change, but generally they're pretty stagnant. So there's all the pros and cons. So the math is you times the mortgage default insurance premium by your total outstanding mortgage amount, And that's called the CMHC premium, or the Sagen, or the Canada Guaranty. It doesn't matter. It's mortgage default insurance premium, and that's added onto your existing mortgage of $475 to give you a total mortgage. And that's a mortgage that's compounded over the next 25 to 30 years. And that's that. That's kind of the price for being able to have the flexibility of paying under 20%. Okay, so most people generally ask me the question of, well, I don't want to pay that. What if I put in 10% today, and in the next 2 years, I aggressively put down prepayments, my property went up in value, and now I own 20% or 21% of my property. Can I suddenly void the insurance and get a refund? The answer is you cannot. The second you close with under 20% down payment, it's like you bought something at the store, you've bought it, you can't give it back. And by the way, you're not paying that default insurance of $10,000, $15,000, $20,000, $25,000 up front. That's just added to your mortgage, and it's amortized across 30 years. So even when you're above 20%, you still owe the default insurance. It's non-refundable. So you really got to decide up front, do I do under 20%, over 20%? Super important detail. And on that note, should you do 20% or under? There's many pros and cons. Here's the video where I talk about where actually doing 10% might be better, even though there's more interest charges. It's all about opportunity cost. What do you put that extra 10% that you would put towards a 20% down payment in the market? So you would do 10% on your house, 10% in the market. You compound that over the next 30 years. There's some math I'll show in the video to show you where it could be worth it. Of course, consult your financial advisor for that. But all to say is that we have gone through the nuances of CMHC insurance. Again, it is mandatory. It's a default insurance. It's to protect the lender against you. I mean, there are some pros on it. So if you have a mortgage default insurance, you'll notice you actually have access to lower rates. And that's because the lender knows they're protected in case you default, so they can actually lower their rate and have less of a margin. Okay, so that's a benefit. Now, does that overweigh the CMHC premium, especially if you only have a 5-year term and it resets after that? I've never seen it make sense there. So that's a bonus, but not a deciding factor. I will say that you can get mortgage default insurance rates, like very similar to them or the exact same, when you put down 35% down payment, if you have the money. Again, you got to weigh the pros and cons, but 35% or more or under 20%, you get the best rates. In between 20 and 34.99, they're generally 0.1 to 0.3 higher. And yeah, a lot of things you got to do trade-offs. This is where you want a good broker, a good financial advisor. It's like, what's going to build your wealth in the best way? What's going to give you the least amount of stress? What's going to give you the most chewable and digestible monthly payment that doesn't stress you out or make you house poor? Okay, so those are kind of the main factors, again, to consider when you are putting under 20% on the mortgage default insurance. To conclude with mortgage default insurance, again, this is something that protects the lender. You're paying for it, and it doesn't matter if you're a first-time buyer or not. If you're under 20% down payment, you must pay this. There's different tiers. Don't forget, you're paying a 4% premium if you are at 5% to 9.99% down payment, 10% to just under 15%. That's going to be 3.1, and then 2.8 if you are at 15% or more. So keep those in mind. Very, very important. Again, if you have down payment that ends up being 9%, for example, you might as well go up to potentially 10%. So if you're really close to those thresholds, consider putting in a bit more down payment. And again, it's non-refundable. Once you pay it, it's paid. It's added to your mortgage. It's mortgage you have to pay off throughout the years. Doesn't matter how quickly you get over 20% down payment. That is a sunk cost. Consider that. And again, there are perks. You get lower rates when you're under 20% because the lender is protected. Again, don't forget, if you're over 35% down payment, similar rates. And again, if you have 20% to put down, just do not default to doing that to avoid this fee because you can put that money in the market. I'm guessing if you're watching, you're somewhat numbers minded, you're an investor, you're a professional, you're an entrepreneur, or just someone that just really wants to have freedom and grow their wealth. So just, don't default to make false assumptions or get scared by these costs. Always look at where can I put my capital in a place that can grow further. With that, thank you for your attention. Any questions, let me know. And I'd love to actually figure out with you, what is the best use of your down payment? What's the optimum down payment to mitigate the mortgage default insurance, but also to have money for other things that grow the value of your property or grow your wealth in the markets. With that, thank you for your attention and good luck.